This house in Marysville, Washington is listed at $825,000, and we're going to walk through a real mortgage quote to talk about what the numbers would look like if you were the one buying this house. Because I know that when you're early in the process of buying a house, it's very confusing. The numbers are all unreliable. There's tons of different information that you're getting, and you don't know how much trust to put in a mortgage calculator online. So I'm trying to provide you some concrete information that will just make you a little bit more confident going into the process, and if you really stick with it, protect you from making a bad decision that might cost you a lot of money and that might cost you the chance at living in a house that you're really excited about. So we're going to walk through this quote, and we're going to talk about what your monthly payment might look like, how much cash you would need to bring all in, and what income it would take to qualify for the loan. And then I'll explain some information along the way that will hopefully set you up to make you really confident and just at peace going into the mortgage process. So let's go ahead and get into it. All right, so here are the numbers, and I've created one scenario for a 10% down scenario and one 25% down scenario. And for both of them, I'm assuming your credit score is 740, just so you know. Some of the assumptions I'm making coming into creating this. So we are going to get into the details here. We're going to get a little bit into the weeds, but I think that's really important to really, again, just make you confident going into the process. Because again, not every loan officer, not every lender really has your best interest in mind, or even knows, even if they do have your best interest, knows everything. So it's important to be educated as a home buyer as well. So hopefully sticking through it and getting into the weeds, even if we are a little bit in the details here, will set you up for success and just get you good, reliable information of what to expect going up into the process. So let's start with the 10% down scenario, and we're going to walk through the numbers. And then we'll come back and look at how the numbers change with your 25% down scenario. In the 10% down scenario, we have a monthly payment of $5,579 per month, and that's made of 4 different components. There's homeowner's insurance here of $175 per month, and that is based on that's an estimate. It's going to vary depending on several factors. It's going to vary depending on who your insurance provider is, and it's going to vary depending on just how much coverage you're getting, what kind of insurance plan you have. But that is a common number that we see for this price point. So that's a realistic number, but it's still an estimate, just so you know. Taxes, on the other hand, taxes here, $298 per month. That's the actual number drawn from the county website for 2024 for this property. So that is the actual number you can expect for taxes on this property. Mortgage insurance of $167 per month. And if you're unfamiliar, mortgage insurance you have to pay if you're putting less than 20% down. And this is a real number. So this is a real quote that I'm drawing. We're a mortgage broker, and this is a real quote we're drawing with one of our lenders. This is a live rate on mortgage insurance, but it varies depending on several factors. It will vary depending on your loan amount. It will vary depending on your down payment percentage and your credit score, and whether you're a first-time home buyer, and several things. But those are kind of the big 3: your down payment amount, your credit score, and your down payment. Did I say that? Down payment percentage, loan amount, and credit score. So that could vary. It could be as low as $30 a month. It could be as high as $300 a month. So that's kind of a possible range for that. But this is based on your 10% down payment and your loan amount and your credit score of 740. So $167 per month for mortgage insurance. Once you get to 20% down, you no longer have to pay that mortgage insurance. Principal and interest of $4,939 per month. Okay, going into kind of the interest rate and one other component here, I'm going to get a little bit into the weeds, but I think this is a really important concept to have a good grasp of coming in, because sometimes your lenders advise you to use this tool that I'm about to talk about, that you should really know what's going on, or even they work it into the loan without telling you. So you should really know what to expect and how to think through it. It's a good option, but you should know what's going on with it. So this principal and interest is based on your loan amount of $742,000 and your interest rate of 6.999%. Now, your interest rate there is, it's not an advertisement, it's not a guaranteed rate for what you're going to get coming in. It's going to vary depending on the market, the day, the credit score, all that. So it's not a guarantee of your interest rate, but it is a good representation of where the market is at right now, where rates are at right now. That's generally where we're at right now for this general profile. 740 credit score, 10% down, but it will vary depending on several factors. So that what I want to point out about this 6.999 is how we got there based on points. This section here, points or credit. Just real quick, this, if you're wondering about that monthly payment, that just means your monthly payment, just including your principal, interest, and mortgage insurance. So it's not factoring in taxes and insurance. It's just like what's your monthly payment from the lender's perspective, not from the whole house perspective. So points or credit. Points, this is the tool that I'm talking about that sometimes will get worked into your loan and you don't know, or lenders advise you to use it and you don't know the implications of it, or if it's a good strategy, if it's a good decision. And so basically what points are is they are a fee you can pay up front in order to get a lower interest rate. So you can pay cash up front in order to lower your interest rate. It's a trade-off there, saying to the lender, I'll make up your loss of my lower interest rate by giving you some cash up front. And credit is the reverse of that, where the lender says to you, I'll give you some cash up front to cover some of your closing costs if you take a higher interest rate and pay it back to me over the long term with a higher interest rate. So should you use points? Should you use credit? Can you use points? Can you use credit? This decision can become pretty critical, and it's not always super straightforward in terms of thinking through. I'm not going to get exhaustive here, but just so you know, why is this zero real quick? Why are we at negative 124? We're showing a credit of $124. Why 124? Basically, when you're getting an interest rate anytime, but especially when you're getting a quote just from a lender, you're rarely going to have the option of getting exactly 0 points, an exact rate of 0 points, 0 credit right on. Basically, they usually show interest rates in certain increments based on, this is the rate we're offering, and here's how much points or credit it's going to take. And they just pick the increments that they're going to show of maybe 7.7, 7.75, 7.5, and so on. So they kind of pick the rates they're going to show, and then they'll tell you how much points or credit it would take to get that rate. And so rarely are you going to get a 0 points option, at least in a quote. There are lenders that offer that, at least for your that you can do that, but it takes some kind of finagling typically. So that's why it's at 124. In terms of should you opt for points, that's a whole new question. But basically, you need to think through strategically how long, because points, depending on the market, rates will be priced differently, meaning it would take a different amount of points to buy down the interest rate a quarter point. Let's say from 7.25 to 7, it would take a different amount of points to go from 7.25 to 7 at one time of year based on the market then versus later in the year. So let's say, right now we're at 6.999. Let's say if you paid 5,000 in points, you could get down to 6.75. That's not always going to be the case. So at that time, you can see, okay, how long would it take for me to make back that money? I've paid 5,000 in points. It dropped down my rate X amount, and on a loan amount of 742,000, here's how long that would take for me to make that back. And sometimes it's a year or 9 months. That's pretty rare. It was that. There was one case where recently we were looking at a loan and it happened to be the case. Typically, lenders know the average life of a loan and they know how long to expect your loan to last. And so typically they're going to price those points in their favor so that they make money on you paying those points, meaning that cash is not going to be paid off before you get out of that loan, whether by refinancing or selling the house and paying off the loan, or however you get out of that loan. So just think through, how long would it take for me to make back these points? And would it be worth it? Do I expect to stay in the loan that long? Will rates be down before then and I'll refinance into another loan anyways, or will I be selling the house before then? And hopefully you'll be able to talk to a loan officer who has some good advice based on your context and your scenario as well as the market at the time. So that's an important concept to be familiar with, but just know in this case you're taking $124 in credit to get this interest rate of 6.999. So what else is going on here? A lock period of 30 days. That just means you're whenever you get an interest rate, you have to lock it in for a certain amount of time, and you have that long in order to close the loan. Typically 30 days is plenty, but there are other options, 45, 60, 90, but typically 30 days is plenty. No prepayment penalty, no penalty for paying off this loan early. Lender fees of $1,195. You're almost always going to see some amount of lender fees on a loan. That's just how that's another way that lenders are paid for their services, basically, besides the interest. They're paying their teams, the people working on the teams and things like that. Any fees they have that they have to pay. So just that's going to be typical, but just keep an eye on that number to make sure it's not getting too high. If you see a number that that looks pretty high, do a little bit of research to see what's normal. But you could see that number getting $5,000 or $6,000. So just keep an eye on that. Other closing costs of $11,948. And you're probably familiar, when you come to get a loan, you're going to have to pay, besides your down payment, you have to pay closing costs, which are costs involved in getting the loan. There are basically two components of closing costs. One is you have to pay just the costs involved in getting the loan and getting the house. The other is what's called prepaids, which just means when you close on your mortgage, there's typically a gap between when you close on your mortgage and you get the house and the time that you start making your mortgage payments. So basically prepaids, which is the other component here, is just taking care of the expenses you're going to have to pay for the first, whether it's a month or a month and a half or whatever it is, before you start making your mortgage payments. Because you are now taking on responsibility for the house, you're paying taxes, you're paying insurance, you have some prepaid interest. So prepaids, and then just costs and services involved in helping you get the loan. So that closing cost of $11,900, almost $12,000, plus your down payment of 10%, means you're going to have to be bringing $95,643 to escrow. That's all the cash you're going to need, all in from start to finish, in order to close this deal. That is the estimate for that number. So it should be a pretty good representation based on real costs that we typically see, but that will vary depending on a few factors that I'm not going to get into right here. Okay, rarely is it helpful to just see one option. When it comes to mortgages, there are countless variables that you can change a little bit, and that impacts your situation significantly. So rarely is it helpful to just look at one option, whether that's down payment or any other options you have. It really helps to contextualize things and understand why your numbers are what they are by looking at multiple scenarios. So even if you're not going to be closer to the 25% down scenario, even if you're more like 5% down or 10% down, it's helpful to see how the rest of the situation is impacted by looking at other down payment percentages. So we're going to walk through the 25% down and see how the numbers change. Right away, you can see your monthly payment is now $4,589, about $1,000 less there. Homeowners insurance of $175 per month. Taxes of $298 per month. Those are both the same. Those stay the same because those are dependent on the house, not the loan structure. But what we are missing is mortgage insurance. We have no mortgage insurance in this scenario because we hit 20% down. Once you get to 20% down, you no longer have to pay mortgage insurance. Now we have principal and interest of $4,116 based on a loan amount of $618,750 and an interest rate of, again, 6.999%. Now the credit that we took, we get a slightly larger credit to take this interest rate. Likely that's just going to be because you are a lower risk profile, so your the cost for you to get a certain interest rate is going to be lower. Basically, you're bumped down in terms of your overall interest rate offerings because you hit 25% down and you have a lower loan amount. So what that means is to take the 6.999 interest rate, which is slightly above the par rate, the average rate, you get an even larger credit of $1,195 now. 30-day lock period, no prepayment penalty again, all these the same. So now closing costs are $10,497, and that's for two reasons. One is because we have more of a credit offsetting some of those closing costs, and two is because we have a smaller loan amount, and your loan amount is going to impact your closing costs. Closing costs will be impacted by lots of things, but some of the big ones will be your purchase price and your loan amount. Those are going to impact your closing costs significantly. So closing costs of $10,500 plus your down payment of 25% means you're going to need to bring $217,942 to the closing table in order to get this loan. So that's our monthly payment. Those are the resulting scenarios. But the question is, would you be able to qualify for those monthly payments? Would the lender approve you? How do you know if the lender, what determines whether they would approve you for this loan? So we're going to look at that, and basically the way lenders decide whether they'll approve you for a conventional loan, which is what we're looking at here, is they look at your debt to income ratio. And, sorry, that's a D. That's a really bad D. Debt to income ratio. Your debt to income ratio, or your DTI, is your total monthly debts divided by your gross monthly income. And they look at this number, and it's going to be a percentage that results. And basically, if that percentage is less than 50%, then typically lenders will approve you for a conventional loan. So the way they figure this out is they look at your total monthly debts, which is your new housing payment that you're trying to take on, plus any other monthly debts you have, student loan, car debt, any other monthly debts. They add that all together, and then they divide it by your gross monthly income, which is your income before taxes. And if that number is less than 50%, typically you're good to go. They will approve you for the loan. Note there, I'm not talking about affordability. I'm not talking about whether you should take on that kind of a monthly payment. I'm not talking about whether you can afford that or a financing or budgeting decision. I'm talking about whether, from the lender's perspective, they will approve you for the loan. That's what I'm concerned with here. It's not finance advice in that sense. So one note on gross monthly income on this number here is that number has to be, someone has to decide what that number is, right? You can, with some pay structures, it's pretty easy to figure out what your number is, what your income is, what you can count on. If you're salaried and you make $100,000 every year, then that is what it is. And typically, then lenders think the same way. And if they look at you and you're salaried and that salary is guaranteed and it's the same number every year, then typically with salary, it's pretty easy to figure out what your gross monthly income is, even in the lender's eyes. Not always, but typically salary is the easiest to get approval, the least possible problems with salary. Other pay structures, though, even salary, if you start to get bonuses included and you budget for those, I make $100,000 a year, but typically I make about $10,000 throughout the year in bonus as well. Or we get our insurance covered through the company. Does that count as income? And then especially once you start to get into other pay structures, like if you make commission and that's going to vary every month, every year, and you just don't know exactly what you're going to make, or if you are self-employed, or if you work variable hours, different hours every week, that one, even if you are, so any of those, it's going to be more difficult to figure out what this number is here and to prove to the lender that it is what you say it is. And typically the lenders have pretty rigid guidelines for what they want to see in order to count that kind of income as income. So, even variable, you might know what you're going to make. Yeah, I'm going to work, basically 40 hours every week or 30 hours every week, and I know my rate, and I can pretty much guarantee what I'm going to make throughout the year. But if it's variable, if it's not guaranteed, if it's not a guaranteed salary, then it counts as variable income from the lender's perspective, and it enters a whole new ball game in terms of trying to get qualified and usable as income. So just know that this number down here has to be the income in the lender's eyes, not just what you say it is. And in order to be deemed as usable income by the lender, it typically has to meet pretty rigid guidelines that they're not all common sense. They're not all, as my dad likes to say, I work closely with my dad. He's the owner at our company. He likes to say it tends to be form over substance with guidelines in the mortgage industry. So it's not super common sense in terms of you can't look at a lender and say, hey, come on, I've been doing this for X amount of time. It's only been 2 months and I've already made this much. They don't look at things the same way. It needs to meet their rigid guidelines. So just be aware of that. But whatever this number ends up being, your total monthly debts divided by that number needs to be at least 50 or no more than 50%. So for these scenarios, let's see what that means. Basically, it's going to end up being just under $10,000 here. What is that? 4589 is going to be 9,000. Let's see if I can do this. 178 per month. That you're going to have to be making if you have no other debts. If you have other debts, you just have to add those and then double this number, and that's what your income would have to be. But if you have no other debts, then in order to qualify for this loan, you'd have to be making $9,178 per month. And in order to qualify for this loan here, what is that? $11,158 per month. In order to qualify for this loan here. So that should give you a sense of kind of what your income would have to be in these scenarios. Obviously, a larger down payment, smaller loan amount, smaller monthly payment, then the required income would be lower. But hopefully that gives you just a sense of where numbers are at right now, and starts to give you a little bit more confidence going into that process. If you want to get a quote of your own on a house that you're looking at, or just start to see what you could qualify for and get a look at your income and see what you could get approved for, please do reach out. My name is Landon Buto. I work with Cleveland Street Mortgage based in Bothell, Washington. We do loans in Washington and Idaho, and we love to work with new clients. All of our contact information is in the description below, and you can also see what our process is like, see what it's like to work with us, see any reviews on our website there. All that information is linked in the description below, so please do check that out and reach out if you are interested.